Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, we got a big deal in the podcast today. I'm excited about this one.
Yeah, we needed to counterweight. The last two were a little off the cuff, and we needed something heavier and deeper.
We needed a heavyweight.
Yeah, we did.
So we're going to be joined by George Gatch, who's the CEO of JPMorgan Asset Management. I'm excited about this one in part because JPMorgan has become such a big force in the ETF industry relatively quickly.
Yeah, and active in general. People don't realize that when you look at all the active mutual funds and ETFs and you add it all together, JPMorgan is now fourth after Capital Group, Fidelity, and Vanguard. And they've come up from like eighth in only a couple years, passing PIMCO, DFA, T. Rowe Price. I mean, these are heavyweight firms. People may not know that. I think they think of JP Morgan, they think of bank more so than asset management, but that is some powerhouse surge there. And they have taken in about 4 times more in inflows than any other active shop. So they are on fire when it comes to active. And it really was embracing the ETF. The ETF is the majority of those flows, although their mutual funds are actually treading water, which helps because they don't have to offset any outflows from the mutual funds, really. And the ETFs have been a big hit. They've got a couple. They've got the biggest stock active ETF and the biggest bond active ETF in the world. Who knew?
Muscle. That's what we call that. So joining us on this episode, George Gatch of JPMorgan Asset Management. This time on Trillions, the new heavyweight. George, welcome to Trillions.
Oh, thank you, gentlemen. Great to be here.
Okay, so when people think of JP Morgan, I think most of the time they think of Jamie Dimon and the bank. Can you just describe how and where the asset management part came from and how you've become such a dominant force so quickly?
Yeah. Well, I think Jamie would refer to us as the hidden gem within JP Morgan. We've been managing money for a long, long time, well over a century. In fact, if you replay the tapes a little bit, in the 70s, during the trust banks, JP Morgan, Morgan Guaranty Trust was the largest asset manager in the world. So we're on a mission to regain that position as being the best asset manager. We have 8,500 employees that do only one thing, manage other people's money. One of the largest commitments to research, fundamental research. And we differentiate ourselves by being exclusively focused on active management. And I think as we talk about our success in ETFs and more broadly in active, I think that's a key differentiating point for us.
And when did that ETF light bulb first go off for you all?
Well, you would have to have been blind to have not seen that ETFs were something that there was a significant amount of demand in the industry. And so about 10 years ago, we said, we think this is a really important innovation and benefit for investors. It was at that time pretty much exclusive to passive. But we thought we needed to develop expertise and capabilities. And so we launched our first ETFs, which were factor tilts, essentially. So we're trying to bring some degree of differentiation to the market. And we've been on a journey. One of the, I think, the important differentiators I said before is our focus on active is we had a debate within JPMorgan Asset Management about should we try to be a scale passive manager? And when I became CEO 6 years ago, I really made the decision that we're going to focus on our strengths and put all of our resources into active. And that was represented in the investments we made in our ETF lineup. We do have some passive capabilities, but those are really building blocks for our active multi-asset strategies, target date funds, and other things that we offer.
So when you showed up 6 years ago and already Vanguard, BlackRock had the passive game like down, was it more of like there's an opportunity in active that those two have conceded and that's how we're going to show up? Or was it like we'll get to the passive stuff later, but we need something like a hallmark product to really distinguish ourselves?
I mean, it's amazing what we saw, which is this massive tidal wave of investors moving from active to passive, and you can see that in flows in mutual funds. And that's also represented in the intellectual capital that many asset managers, they focus their resourcing, their research on tracking markets. And they did a good job of it, and it was highly appealing to investors. I saw that as an opportunity where we could help exploit the ability to outperform markets because there was simply less focus on it from most of our competitors. I also think there's this kind of cultural underpinning that's very powerful to have 8,500 people that are all believe in the ability, if you have sustainable sources of information, of an information advantage, of the ability to outperform markets. And that's important for our sales teams. It's important for our product development, operations, fund accounting, et cetera. Everyone believes that we have an advantage and we can exploit that to help people outperform markets.
So I've been watching you for years. I saw you guys come in, and I saw the passive first, sort of the beta knockoffs. They did okay. There was some BYO money. But then JEPY to me really changed everything, and JPST, that's the bond and the stock one that are the biggest. What I found interesting, and what I think, this is my theory on why it has worked so well, because you came in and really made an impact on something that people were kind of writing off a little bit. Most of these big asset managers, they were like, hey, let's come out with like free index funds like Fidelity just to offset the active outflow so we look like we're in business still, versus just bleeding out slowly. But you guys are like, no, we can make active work. One thing you did that I think takes guts, though, is the expense ratios. To me, they feel fair. A lot of the problem with the active management is it's like 90 basis points. It's largely S&P 500 stocks. They came in, JEPY's 35 bips. That's the same as the R6 class of your mutual fund, which is the cheapest class. So in essence, they're giving the ETF investor sort of the cheaper share class of the mutual fund. Not only that, you get fundamental stock picking. There's an options overlay, so there's a lot of legwork involved. And it's JPMorgan. So I'm thinking of an advisor always. I'm always in their brain going, does this seem like a good deal? It's like they can go to their client now and say, hey, look, I'm going to get you JPMorgan. That's really cool. That's lucky you have that. A lot of firms don't. I'm going to get you an options overlay. And it's just like, it's going to take the vol down a little bit, yada, yada. It feels fair at 35 bips. And I think that's part of the magic. Would you agree?
Yeah, no, absolutely. And I think we all know, and we've looked at other industries and other firms, if you don't evolve and adjust your business model to the changing needs of investors, financial advisors, your business will wither. And so, we made decisions to build products we think that from both a pricing and an investment standpoint have a highly differentiated offer relative to others. Now, we didn't apply the strategy of a covered call options only in an ETF. We actually did it first in a mutual fund. So what we're doing is bringing our best ideas that we have in mutual funds, separately managed accounts, what we've run for institutions, and then putting them in an ETF, and then going through a process of how do we price that relative to the value that we're adding to investors. And the great thing about ETFs is there's very little friction relative to revenue share or transfer agency costs or other things. So it allows us to do it at a price point where then financial advisors can make the decisions to add fees for the services they're providing. And so what this has really done is seen the disconnecting between manufacturing and the costs associated with manufacturing versus services related to advice and financial planning and other components of high value-added things that advisors do themselves. And I think that's one of the reasons that ETFs has grown so rapidly, both in passive and active, which is you see this movement towards fee-based programs and away from transactional revenue sharing and other things. That's good for investors. And so we're playing to that theme in the way that we price and service products.
I will say you make that sound easy, but over the years, I think the fund companies that are just fund companies, it is tougher for them. I see them sometimes try to make the ETF industry come to on their terms, and it doesn't work. You kind of have to meet the ETF industry on its terms. And I thought JPMorgan
feels like judo a little bit. Like we're going to use the energy and like redirect it a little bit rather than take it head on. You like that? I brought Olympic sports in here.
I like metaphors. I don't know about that one, but it's hopefully everybody listening understands. That flew over my head a little bit. But the idea of having a bank where asset management is a portion of the revenue, and obviously Jamie Dimon has all these other groups making money. There's a lot of things to work on. And so it's not like the whole thing depends on this one mutual fund revenue stream. So you can make that ETF leap a little easier because it does involve a little bit of self-cannibalization. Although if you get enough assets, you win in the end. But it's been tough for the traditional 90s era mutual fund company to do that because this is all they have. And I don't know, do you feel like that you work in this gigantic diversified bank type company? Is it give you a little more freedom, or is that more just the Jamie Dimon management thing to just let you do what you need to do? Because I don't feel like others are given the keys so much as you guys were in terms of pricing it and being able to sort of maybe go a little cheaper than you probably would like to.
The way I think about it is the asset management business is to serve investors, and we are measured to compete with the best asset managers in the world. That's the way the board and that's the way Jamie judges us. And we have the ability, because it is a fiduciary business, this is a very important point, and we're hermetically sealed because of the conflicts that exist between the bank and the asset management. We can't trade in our ETFs with JPMorgan Chase and Company. But we have the ability to reach out and pull in the expertise and skills that are maybe difficult for other monoline asset management firms to get. Cyber, technology, artificial intelligence. The bank has some $17 billion a year on technology. We have the ability to pull in generative AI expertise to help apply that to managing money. So I would describe this as the best of both worlds. The other thing I would point out, which I think is important for us, is there are kind of two ways that asset managers approach this. One is around marketing, what's best to sell. And then you have others who are deep fiduciary managers where they lead from the investment standpoint. How do you generate returns for clients in a risk-adjusted way? Some lean too much in one way, therefore haven't been able to adapt their product offering rapid enough. Others lead the other way, and they end up producing products that aren't in the long-term investing interest of investors. What I think we have been able to do is balance that decision-making between a very strong investment-led fiduciary culture and a very strong focus on investor needs and demands and adapting our product line and capability more rapidly maybe than some of our competitors have.
We talk about a lot how the ETF is a terror dome. The ETF industry is a terror dome, and that it's taxing, especially for all the juggernauts that have to compete with one another. What's it feel like to walk into the terror dome every day and have to compete?
Oh, it's great. I mean, this is one of the most exciting areas of the industry. I mean, the level of innovation. You pointed out the competition, and it is invigorating for our teams and my people. And I think that's one of the things, because ETFs are, maybe they've been around for a long time, but they're quite fresh as it relates to the active asset management space. And I think it's bred a degree of optimism and focus on the future. And the competition is awesome. You think about like what the competition in the asset management space has meant for the quality of what investors get today, and the innovations that we've seen in mutual funds and separately managed accounts, tax optimization, and all of that I think is culminating in a seismic shift that's happening, where ETFs will likely be the most important product and vehicle for individual investors and maybe institutions for the next decade. So I think it's incredibly exciting.
Yeah. What does it feel like to compete against you?
I feel sorry for them.
Actually, that's a good segue. I have a good example of what I think of. We always look for these interesting matchups inside different categories. And, I titled this Vanguard versus JPMorgan, grab the popcorn. So
I'd get some
JPMorgan,
popcorn for that.
yeah, I mean, this is really interesting to me. JPMorgan launched a high yield active bond ETF, JPHY. It's seeded with $2 billion, which is unheard of.
It's a pretty good start.
That's a good start. You're already the biggest one. It's nice, just like that's like born on home plate right there. Now, a couple weeks later, Vanguard filed for an active junk bond ETF, and everybody had been writing them off because people had thought they would file for a junk bond ETF at some point. Everybody wanted them to because they have a mutual fund, and they never did. And I think you got them to launch, in my opinion, because they see the numbers. Vanguard is 19th in active ETF, and they're not 19th in anything. That probably pisses them off. And they see you come in, you're cleaning up, you're running circles around them, and you're basically biting at their heels right now in third place of overall active. So that I can't ever say I've seen Vanguard look a little nervous, but this looks like that.
I mean, Vanguard's a great firm. And obviously huge innovator in ETF space. The way I think about it, $3 trillion in fixed income ETFs globally. 85% of that is indexed, passive. This is a space where the average manager outperforms the market. So I think investors have loved the ETF package and therefore have gone down that path of allocating to fixed income. And now that there are world-class capabilities, active capabilities in ETFs, I think we're going to see a massive shift. And what we did was we went to one of our largest clients, one of the most sophisticated asset owners in the world, and asked them whether they wanted to participate in us launching a high-yield ETFs. And that shows the strengths of our traditional institutional business and relationship. On day one, the ETF had 450 positions sourced from our credit and portfolio management capabilities. So as an investor, if you came into our fund on its first day, you would be fully diversified in the sectors and securities that we think are most attractive. It's a great thing. I never thought I would see the day where we were able to launch a ETF and have it be the largest ETF in the category on day one. It's a great position to be in.
I want to talk about JEPY because we mentioned earlier JPMorgan Equity Premium Income ETF. That has just crushed it. And can you dissect why JEPY has been such a success, and also, were there any other names that you considered for the ticker?
We're always wondering about the best tickers. I mean, I think this is, as I said before, this is not a strategy that was first in the ETFs. It came to our mutual fund lineup first, and it offers the investors the opportunity to get their toe in the water, get allocation to the upside potential of equities, but at the same time generate very attractive income and have some less volatility in delivery. So I think it's an idea that has applications to every asset class. I think it's a core position over the long term. As we see volatility spike, you're likely to see greater demand for these types of products in markets like today, where you have momentum in stock prices. It's likely to be something that's not the first choice. But over time in a market cycle, I think these strategies, and we've obviously replicated it not just in S&P 500 with JEPY, we've done it in NASDAQ stocks with JEPQ. We've also applied a similar strategy to our hedged equity. We have one for U.S. strategy, and we also have one for an international strategy called OLA. I think these types of products that give you equity exposures, either downside protection or high levels of income, will continue to be quite attractive. We launched them around the world, Canada, our product range in UCITS and in Europe. We were the first to list a active ETF strategy in Hong Kong 2 weeks ago, which is actually a replica of JEPY. So this is an area where we're seeing demand globally around the world for these types of strategies.
If you look at Europe, I was just in Europe a couple of weeks ago, and Henry showed me the active ETFs there. JP Morgan's like in a league of their own. So like here, they're obviously right up there. There's a couple good active ETF managers, although some of them take money from the mutual funds. So they offset when you look at the both. That's why when I looked at your numbers in terms of mutual fund plus ETF, it was very impressive because your mutual funds were able to at least eke out a little bit of flows, which is not the norm. JEPQ, which is the one you mentioned, it's JEPY's little brother, except it's a little more feisty because the Qs have more volatility. So it seemed like to me that JEPQ is double any other of your ETFs and flows this year. So it's kind of like it hasn't surpassed JEPY in assets, but it's getting, it's taking in more money. I think the idea here is if you write call options on the Qs, what you do is you give up extreme upside, but what you get in return is some income. So it yields 11%. That income can actually buffer the downside a little. So in essence, it's like diet Qs in a way. And that to me is a strong selling point that is somewhat performance proof, because if you have a year where you underperform the Qs, the value proposition is still there, because a lot of older investors are like, I'm happy to give up a little upside. I've made a lot of money. And that deal they strike with an issuer like JEPQ or JEPY, it's a brilliant concept because it doesn't totally rely on performance year to year, like say other ETFs. Do I have that right?
Yeah, absolutely. I think this is why these strategies are so durable, because I think the demand for these types of products of high income, exposure to equity markets and less volatility, I think that's a theme that we're going to see to continue to play out. Now, it is the number one selling product that we have year to date. And I think this is an important point relative to kind of our strategy around this. If you look at, we got into the business and saw strong flows through these derivative income strategies, JEPY and JEPQ, and through our short duration fixed income JPST, which is the largest fixed income ETF in the business. But over the last 2 years, more than half of our total flows have been in other products. And I think that's what I see. I'm so encouraged about the strength of active fixed income, which I mentioned before, our JEPY, which is an income fixed income ETF, our Core Plus strategy, which is our best-selling fixed income capabilities. I think that's what you're going to see happen in the industry. Is we're going to see more and more flows expanding into other areas as more investment capabilities become available.
And you oversee everything, right? So you got mutual funds, ETFs, and I read a little bit about your push into alternatives. What does that mean? What is the push into alternatives? BlackRock says the same thing. I think some people like, what does that mean? And what kind of products should we expect?
And does it mean crypto?
That's don't worry, I'll get there.
So 60-40, diversified investing. Add alternatives to a diversified portfolio and you increase return and reduce risk. Not a new novel idea. It's been around for a long, long time. We've provided those tools for our big institutional clients for a long, long time. And we've got leading capabilities in real estate, infrastructure, hedge fund of funds, private equity, et cetera. And I think there's two parts of this. One is we believe in building stuff internally. So we have a number of investment strategies that we've seeded, growth private equity, a number of things that, over time will become important options for our clients. So that's part of it, expanding the universe of offerings that we have for clients.
So you said private equity, and I think, did you launch a interval fund that has private equity, credit, or both?
Yes, we have two strategies today that are private wealth alternatives. One is called JPMF, which is a private equity strategy, private equity secondaries, co-invest, and fund to fund. And we also have a JPM REIT, which is a tender offer strategy. And both of those are designed for individual investors, have lower minimums, W-2 tax reporting, et cetera. So,
but the interval means you can only get your money out quarterly. something like that, or is it something?
Yeah, it depends on the strategy and the fund, but yes, there tend to be limits on redemption. These are illiquid strategies, so it's very important relative to education and disclosures to clients.
It's interesting you picked the interval fund. You're not alone. I think Blackstone picked one. Vanguard is looking into it, but there is a small shop or two, and State Street that is trying to put privates into ETFs. I do think ETFs are the preferred vehicle. That to me, they are like digital music. An interval fund feels like putting it into a CD. You probably could get it done and listen to the music that way, but it's not as convenient. On the flip side, privates are illiquid. So, people hesitate to put them. But what do you think of this move to try to get privates into ETFs and even further to democratize them fully? There's some talk of like, well, this is the private companies just trying to unload this stuff on retail because they had a nice run. And the NAVs that they price all the privates at sometimes aren't quite reflective of reality, versus when you put something in an ETF, you got to price it every day. I don't know. What do you think of all that? It seems like something that's on the cusp of like really breaking through to the retail world.
Yeah, Eric, I think it's a great question. Interval products, and there's a range of capabilities that now can be delivered in structures designed for illiquid securities. And that's where our focus is building out these capabilities of private equity, private credit, infrastructure, et cetera, to make them available to individual investors to complement 60-40. ETFs, like public mutual funds, are priced daily. Illiquid securities have been used in public mutual funds and in ETFs, but below the 15% liquidity illiquid bucket. And I think the principle should be if a product is priced on a daily basis, that there should be limits to the amount of securities and the strategy around valuations. So I think we should be very cautious about how we integrate private securities into ETF structures. There are other vehicles where it makes more sense. The disclosure is better. Now, I'm not saying there aren't opportunities to include illiquid securities in ETFs, but we have to be very mindful of the issues that you raise.
How much demand is there on the consumer side for products that have this illiquid stuff but are effectively an ETF? Do you see the demand there?
No, not necessarily. I say demands for the ETF structures, which are suitable for daily valued securities. So I'm not saying we see a significant amount. Now we do see demand for private alternatives to individual investors, significant demand.
Question though, is the demand because these private equity vehicles seem to have less volatility and can be a true alternative? But then, there is some criticism that, well, the reason they're alternatives or have lower volatility is because they don't have to live in reality of a true market. For example, SpaceX probably has a similar profile to Tesla, but you wouldn't know it from the NAVs. And I think this is one of the critiques of private equity, is that largely they're going to move like public equities if you put them in the reality. And I believe there was even a story on Bloomberg about JPMorgan trying to trade some of these, and these private shops. It just seems like they're a little hesitant to actually let this stuff into the reality of a real market, because it's like it would remove the veil. What's the emperor's new clothes? What's the emperor has no clothes? The emperor has no low volatility. Sorry, that's almost as bad as your judo metaphor, but you know what I'm saying. Am I wrong there, or do you think there's some of that fear of and so does retail, do they understand that, or is it just a matter of less companies go public? Hey, I want a piece of the action of these companies, but that aren't going public.
I mean, these securities trade on appointment. And I think you have to be not every minute of the day. And so I think, that needs to be taken into consideration. But there's some realities here, right? Which is a decade ago, there were 8,000 public companies. Today, there are 4,000. There are multiples of that in terms of private companies that offer return opportunities to clients. And the same is true in the fixed income markets. There is a large growing market of private securities that offer return opportunities for individuals individual investors. The question is packaging that in the right way. If investors have long time horizons, they shouldn't be concerned about what the pricing is on any individual moment. And I think that's the opportunity with some of these vehicles that offer exposure to these markets, but are also disclosed that you're not going to get your money every day. ETFs, you're going to get your money every day. Valuation is incredibly important, and that needs to be the premise around the types of securities that you include in these portfolios. And I do agree. I think people are salivating over the opportunity in the ETF market and the individual market, and they want access to it. But we have to be thoughtful about it, and I think that's the perspective that we bring.
Speaking of thoughtful, when I've been running these numbers on IBIT and Ether, that's the BlackRock, Bitcoin, and Ether ETF, when I run like fastest to 20 billion, and I look at all the ETFs that have got to 20 billion quickly, or fastest to 10 billion, IBIT blowing everybody away. But guess whose record they're breaking? It's either IMG, which was a fast, and JEPY. So here comes IBIT getting to 10 billion, 20 billion, 30 billion, 4, 5, 6 times faster than JEPY, which was in some cases the fastest to that number. You see that, what do you think? Is there any bit of like jealousy, like, hey, we should get a piece of that action? Or I don't know. I'm just curious, as the numbers grow and become more astonishing, and a firm like JPMorgan, which is traditionally, it's not what you do. And if that's your roadmap, it wouldn't make sense. But on the flip side, more companies are doing it, and it's growing and growing, and you may hear clients asking for it. I'm just curious how you wrestle with all that.
Yeah. Listen, I think we have a guiding principle around what types of ETFs we will launch. And we're going to launch ETFs that we believe are durable and have a strategy for how to incorporate into a long-term investment strategy. Now, I know that may sound kind of boring, but boring can be quite successful investment strategy. So that may mean that we lose some trendy, fatty ideas, but we're gonna stick to our guns. I think that cryptocurrencies are quite a speculative investment in quotation, and it has significantly higher volatility than the S&P 500, no income, no intrinsic value. We don't know how to incorporate it into an investment. I'm not saying it's a bad thing. I'm just saying we don't see a way that we have summer analysts who come in, and one of the projects we always give them is give us an investment thesis around crypto, Bitcoin, and they come back and say we can't tell you how to value a Bitcoin. And so that's the premise around our investment capabilities. And listen, there are lots of ideas that people are launching: water ETFs, animal spirit ETFs. That doesn't mean they're good ideas. And we're gonna stick to those things that we think make sense for investors, and that's the discipline we bring to our product development efforts.
If you could pick up one thing in the ETF marketplace and bolt it to your strategy, what would you like to acquire?
What would I like to acquire?
Yeah. What ETF out there would you most like to bring into your stable?
Listen, I think acquiring things as an asset manager is incredibly difficult to do successfully. We run almost $4 trillion of assets. We have over 500 strategies. There isn't a gap in our offering. I also find it, having built a lot of businesses at JPMorgan over the last 39 years, from our global money market fund business to our mutual fund business to our ETF business, let me tell you, it is a hell of a lot more fun building things than it is acquiring things. And that doesn't mean we don't look at everything we do, because I think it makes you smarter. I think there's quite a different culture in the ETF business because it grew out of passive. So the strategy was, let's launch against as many indices, be first, and own as much of the market as possible. I think as that relates to active, it's quite a different philosophy that you need to bring to it to be successful, because the strategies ultimately have to outperform in order to succeed. And that means it needs to be more focused, and they need to be capabilities that you have total confidence over the full market cycle are likely to outperform. So ours isn't to do everything at all costs. It's to do things at a very focused level where we have a competitive advantage. I'd rather build it than buy it.
You're in a good spot. I mean, you really, I get that. A lot of these firms, Joel, that have acquired firms, they came in late, and again, they launched a couple products on their terms, and nobody cared, and they're like, oh my God, they panicked and they just bought companies. Like I said, JPMorgan it's like they just came in. I use that metaphor of Castaway. Tom Hanks is the middle manager at the beginning. He's like a little chunky. And then, 45 minutes in the movie, he's like weighs 140 pounds and he's spearfishing. That's a legacy active manager on day one versus third year in. But JPMorgan kind of came almost as the spearfisher guy. And that's, again, and I don't know, does Jamie Dimon take pride in this? Because it really is unusual to come out and sort of pass all of these massively popular mutual fund companies in active assets. Does he understand that, like, hey, my firm is taking in 4 times more flows than any other active fund company out there? Does he even follow this stuff? Or does he have that much going on?
I think he greatly appreciates the asset management business and the strength of what we do. Now, remember, JPMorgan Chase is number 1 in investment banking, number 1 in retail banking in the United States. So perhaps his expectations are that we bring the same from the asset management business.
Yeah. He's like, great.
Why are you not number 1?
Yeah.
But listen,
great.
the thing that the board of JPMorgan Chase, one of the things that I think they've done a great job is they allow us to manage our business as an asset manager, as the way we compensate people. Our business has a very long tail. The decisions that we made 5-10 years ago are the reason that we're having success today. So it's a little bit different, and I think they allow us to manage the business that way.
All right, final question. It's one that we always ask. What is your favorite ETF ticker other than any that JPMorgan does?
Other than a JPMorgan ETF?
Yeah.
Oh, that's a very difficult question.
That's why I asked it.
I mean, I really only know our ETF, so.
Yeah. Any that give you a chuckle when somebody says moo, for instance? Does that make you laugh?
I laugh quite a bit when I look at ETF product development and what's coming out. That is for sure.
They just filed one, JEPY, which is like JEPY. JEPY is I believe it's a space ETF or something like that. Drones. I don't know, something.
I would hope it would be space.
That's a good ticker.
It is a good ticker. So JEPY, and now JEPY. Anyway, JEPY's pretty good. I'm a big fan of vowels, and you guys have a lot of vowels. JEPY, JEPQ. It's just easy for an analyst. JPST, a little trickier, but hello, what do you call it? Hello? Mm-hmm. Sometimes I have names for tickers, and the asset managers, like, nobody at our shop calls it that. Like, JA.
You're not pronouncing it great.
Yeah, the Janus people are like, that's JAAA. Only the Bloomberg people call it JA. And I'm like, all right, well. Anyway.
Well, that's one of the amazing things about the ETF effort at JPMorgan. I'm not sure portfolio managers knew the tickers of our mutual funds, but let me tell you, they know the tickers of the ETFs that they're running, and it's probably the most important product capability that they offer, and it's how they get paid. They get paid in the shares of the ETFs that they run on behalf of clients. It's pretty unique.
Hola, Jade. That's a good one. What's Jade? That is a active developing markets. So you temp, some interesting ones in here. It would be weird if you went too crazy. You don't want to go too full.
I'm sure there's the
full direction.
The ones
they're
like,
the crazy
no.
ticker.
Yeah,
you want to middle it out.
JPMorgan.
Yeah.
All right. George Gatch.
We're going to stay mainstream.
George Gatch, thanks for joining us on Trillions.
Thank you, John Munn.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Brendan Newman is our executive producer. Sage Bauman is the head of Bloomberg Podcasts.